Hi guys, welcome back. Today we are going to continue with valuation across the company's life cycle. So again, according to Aswat Damodaran, the stages of the life cycle include young, growth, maturity, and decline. We will focus our attention this time on mature companies. How would we define a mature company? We may be tempted to assume that a mature company is simply a company with a low growth rate. While this is usually true, this is not a good definition, as it is possible even for mature companies to grow at a higher rate in terms of earnings due to factors other than the growth of the volume of activity. Mature companies may experience from time to time a high growth rate due to cost savings from operating more efficiently and other factors. This is the reason why assuming that a mature company is simply a company with a low growth rate is not a good definition. A better definition of a mature company would be something like this. A mature company is a company that gets a significant portion of its value from its existing investments rather than from investments that are yet to be made. Remember from our previous video where we defined growth companies as the opposite, getting most of its value from investments that are yet to be made. So for mature companies this time, the value comes primarily from investments, those assets that are already existing, rather than those that are to be acquired in the future. So this is what a mature company is. We may list the following characteristics for mature companies. Mature companies, they have revenue growth that is slowing down, approaching the growth rate of the economy. As companies become mature, their growth rate on average typically goes low. I'm talking about the growth of revenues. Why? Because they have passed the stage where they are growing exponentially from period to period. At this point, they have already saturated the market. Now, the growth rate of mature companies tend to converge with the growth rate of the GDP in the economy where it operates. That's the tendency for companies as they become mature. Next is that the margins tend to become established. So when the operating margins is say 10%, it is now more or less 10% from period to period. They become established. Unlike the growth rates of growth companies where it may fluctuate from period to period. The exception is that for mature companies which are offering commodities such as oil and energy, they may experience revenue volatility due to the nature of their product. Then we have another characteristic as well. Mature companies tend to have a competitive advantage. A competitive advantage is something makes the company more profitable than its competitors. Maybe it is stemming from something that they possess which others do not have, such as a patent on their product or service, or maybe some internal knowledge, maybe some knowledge that they possess which other companies do not. Another characteristic is that mature companies tend to have debt capacity. They are now able to borrow. This is due to the fact that mature companies are already stable. Now, they can afford to accrue debt, so their capital structure would more likely include some level of debt. Then finally, mature companies tend to have a cash build-up because there's now limited opportunities for growth, for reinvestment. There would be more cash build-up, which they may distribute in some form in the future. usually in dividends and stock repurchases. Now, what are the valuation implications for a mature company? Let's start with the issues in discounted cash flow techniques. Notable concerns for a mature company include: number one, the current way the company is managed may not be optimal. Past performance may reflect inefficient operations. What is good about valuation of mature companies is that we can see a pattern from the past. What the revenues are, how they are growing, what the margins are, and they tend to be more stable compared to growth companies. However, questions may arise as to whether this is the best way of doing it. Maybe the margins are not at their highest yet. Maybe if it is run by a better management, the margins can go higher. And maybe the growth rate is not optimal as well. Next, we have the growth of mature companies are accomplished through acquisition rather than organic growth. So this is an inorganic rather than an organic growth. This begs the question, how are we going to assume a growth rate? So this is another concern when it comes to the valuation of a mature company. Then finally, the use of debt in the capital structure would complicate the calculation of the cost of capital. Remember that growth companies, they tend to have no debt. This time, for a company which is now matured, they tend to accrue debt. And it further gets complicated when we look at what kinds of debt they are issuing. Maybe they are issuing different kinds of debt. Maybe they are issuing bonds that are secured, mortgage bonds, bonds that are not secured, debentures, bank borrowings, etc. It gets more complicated when we look at the list of the possible debt issuances that they may use. Now, what are we going to do considering these are issues in using the DCF techniques for a mature company? I am going to start with the second issue. The growth made by mature companies is by acquiring rather than an organic growth. Let us say the case of Jollibee Foods Corporation. Jollibee Foods Corporation, when it has already grown to its mature stage, they grow further by acquiring different fast food chains and restaurants rather than adding more Jollibee outlets. So, cases like this will raise a question. How are we going to assume the growth rate? What we can do, if this is the method by which the company grows, is to assume a smoothed growth rate. Say for example, every 5 years, an acquisition worth 20% of its value is being made. So maybe we can assume the growth rate to be 4% per year for the next 5 years. Now, as for the issue on management of the company, is it already at its optimal level? I want you to imagine that you are a potential acquirer of the company. Now, if you are a potential acquirer, you might consider this question. Why would you acquire such a company? Why not simply buy the stocks of the company and let it run its course? Now, the main reason why you would acquire the company is because you believe it is managed poorly. This is the reason why you want to take control. You can give a better performance if you are going to run the company rather than the existing managers. So, in dealing with issue number 1, think of it this way. You are a potential acquirer. What value are you willing to pay to acquire such a company? Are you willing to pay a value equal to the value being generated as a result of how it is currently run? Or Are you willing to pay a value based on how it is going to be run optimally? That is, in its best possible way. So to answer that question, we have to calculate first the value as if things are as it is, and then the value as if it is being run the best possible way. So let us look at the following template. This is how we do the discounted cash flow technique for a hypothetical company. So we basically project the cash flows. The cash flows here for years 1, 2, 3 until infinity. But of course, we are going to determine a terminal date at some point where we would assume that the company will experience a constant growth rate moving forward. Then we are going to discount all of these cash flows back to year 0 to arrive at the value. Now, the first kind of value that we need to take is the value of the status quo. The status quo value is the value as it is currently being run, the inefficient way, the way it is currently being run by the existing managers. We call it the value of the status quo. Next, we are going to calculate the value assuming that it is ran at its best. So assuming that the inefficient management will be replaced by the best possible manager for the company, we are going to make some adjustments in the variables. For example, the cash flows will become higher. So say for example, the company is now being run in its most efficient way. The cash flows would go higher, 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 maybe due to operating efficiency, savings from costs, maybe due to added revenues because of a better management. And then, we are also going to extend the terminal date. So, if the terminal date is assumed to be at year 3, we're going to add 2 or 3 more years to year 5. Why? If we're going to make some changes in the company, making it better at its best, it would take a longer period of time before it will normalize. So we may want to extend the cash flow projections to a little longer. So the terminal date will be a little further. Then finally, we are going to adjust the discount rate as well. What kind of discount rate we're going to use? The optimal discount rate. Now, in capital structure theory, the best possible capital structure is one that would minimize the overall weighted average cost of capital. Even those changes to be made, we may now calculate the new value, which we call the optimal value. So far, we have made 2 calculations. The value in the status quo, which is the existing business, and the value assuming it is being run optimally, where cash flows will become higher, the growth rate may be higher, and the discount rate will be lower. We may now calculate what we call the value of management change. The value of management change. The value of management change is the difference between the optimal value and the status quo value. The value of management change is the added value when you are going to replace the management with the best possible manager. We call this the value of management change. Now, how do we arrive at the intrinsic value of the company? Well, the intrinsic value of the company, we would start with the status quo value, and then we are going to add what we call the value of control. What's the value of control? Well, basically, it's the value of the management change, but adjusted for the probability of that change to happen. Of course, there's no guarantee that the best managers will be able to take control of the company, considering there are possible defenses against hostile takeovers. So, the value of control is the value of management times the probability of changing management. So, again, what we need to add is what we call the value of control. the value of control is the value of management change, the difference between the optimal and the status quo values, multiplied by the probability of that change to happen. How do we arrive at the intrinsic value? We arrive at the true value of the company by adding the status quo value, the value as it is currently being run, the value of control, the value of management change multiplied by the probability of that change to happen. So basically, that's the adjustment that needs to be made when it comes to mature companies. Now, let's look for the notable concerns in valuation, this time assuming we are using relative valuation. Now, the good news about relative valuation is that we have a lot of multiples for our use. We can basically use the price to earnings ratio. We can use the price to book ratio. We may use the enterprise value to EBITDA, enterprise value to revenue. There are a lot of multiples for our usage. The problem, however, with having a lot of multiples is the fact that we do not know what to use. Are we going to choose price to earnings? Are we going to use enterprise value to revenue? The problem with having a lot of options is that we are going to be paralyzed in thinking, what are we going to use? So that would be a concern in valuation, having too much options. Furthermore, the multiples may fail to capture the difference between how the company is run and how comparable firms are run. So these multiples assume that the ratio of price to earnings, say for example, would be the same for all companies on average. However, that would fail to capture the fact that they have different managers. So these are the issues and concerns in valuation of mature companies. Thank you for watching. Comment for the future topics that you would like to request. Don't forget to hit the thumbs up button if you like this video and hit the subscribe and notification bell to be updated for future videos.